You know, if you look back at the headlines from 2023 and 2024, there was this overwhelming consensus. Everyone from the Federal Reserve to your local real estate agent seemed to agree on one thing. The housing market was due for a correction. The logic was simple. Interest rates were going up fast, and when borrowing money gets expensive, house prices are supposed to come down. It's basic economics. Gravity. But here we are in 2026, and gravity seems to be broken. The crash didn't happen, but the boom is dead too. Instead, we've drifted into this strange, stagnant middle ground. It's a market where nothing moves, where buyers can't buy and sellers won't sell. We call it the squeeze. And honestly, it's much more frustrating than a crash. A crash is loud and obvious. This is a quiet erosion of the middle class. It's a story about how the home, which used to be the primary way normal people built wealth, has turned into a gated community that most people can no longer enter. Over the next hour, I want to unpack exactly why this is happening. We aren't just looking at charts. We're going to look at the structural mechanics breaking the market across the globe. We're going to look at Florida, where the insurance industry is quietly forcing people out of their homes. We'll look at London, where changes in the law are causing landlords to vanish. We'll go to Canada to understand a very specific financial ticking time bomb called negative amortization. And we'll look at Poland to see how institutional money is capitalizing on all this chaos. We are Drea Meta Visual Studio. This is an investigation into the global housing trap. Let's get into it. To really understand the mechanics of this market, it helps to step away from the big data for a second and look at the incentives of the actual people involved. I want you to picture two distinct types of participants in today's economy. First, let's look at someone like Ben. Ben is your typical millennial buyer. He's in his early 30s, lives in Tampa, has a decent job. 10 years ago, Ben would have bought a starter home by now, no problem. But today, Ben is stuck renting. He's watching his rent climb every year, and he feels like he's running on a treadmill. Ben views the market through the lens of affordability. He looks at high prices and high interest rates and thinks, this is unsustainable. Prices have to drop eventually, right? Then you have someone like Alex. Alex isn't looking for a place to put his couch. He's an institutional operator based in London. He manages capital. Alex doesn't care about affordability in the emotional sense. He cares about yield. He cares about the spread between the cost of debt and the income from rent. Right now, Ben and Alex are staring at the same housing market, but they see completely different realities. This is what we call a parallax view. Ben sees a frozen market with low sales volume. He interprets that as weakness. He thinks sellers are stubborn and will eventually crack. But Alex sees the math differently. He understands why volume is low. It's not stubbornness, it's the lock-in effect. Here is the reality of 2026. Most homeowners are sitting on a mortgage rate of 3% or 4% from a few years ago. The current rate to buy a new place is over 6%. If that homeowner sells, they lose that cheap debt. Their monthly payment for a similar house would effectively double. So they don't sell. They stay put. They renovate the kitchen instead of moving. This removes inventory from the market. And when there is no inventory, prices don't crash, even if demand is low. So Ben is sitting there, waiting for a price drop that the math simply won't allow to happen. That is the fundamental gridlock we are living in. Now, let's go back to Ben in Florida for a minute. Because even if interest rates dropped tomorrow, Ben faces a new problem that nobody was really talking about 5 years ago. It's the insurance crisis. While everyone was hyper-focused on the Federal Reserve, the insurance markets were reacting to climate data. In states like Florida, California, and parts of Texas, major carriers have simply stopped writing new policies. The risk models don't work anymore. The cost of rebuilding after a storm is just too high compared to the premiums they can charge. So, imagine Ben finally finds a house. The price is okay. He can stretch to make the mortgage payments. He calls an insurance agent to bind a policy so he can close the deal. The agent asks about the roof. Ben says it's 12 years old. In the past, a 12-year-old roof was fine. It had plenty of life left. Today, the agent tells him that the home is effectively uninsurable in the private market. This forces Ben onto the state-backed insurer of last resort. The coverage is thin, and the premiums are brutal. In 2026, insurance isn't just a minor line item in your budget. It's often 9% of your total monthly housing cost. It's a massive hidden tax. This has created a two-tier market, something our institutional investor Alex calls the brown discount. Homes that are climate resilient, new roofs, high elevation, storm shutters, retain their value. They are liquid. Homes with older infrastructure or bad geography are becoming illiquid. You can't get a normal mortgage on them because you can't get normal insurance. This means the only people who can buy them are cash buyers who self-insure, people like Alex. So Ben gets priced out not by the house itself, but by the risk attached to it. Let's hop across the Atlantic to the UK. The situation in London is different, but the outcome is the same: a shortage of homes for regular people. Here, the issue isn't climate, it's regulation and math. For a long time, the UK rental market relied heavily on accidental or amateur landlords, just regular people who bought a second flat as a pension investment. But recently, the government introduced the Renters' Rights Bill. It provides much better security for tenants, which is a good thing socially. But it also bans no-fault evictions and requires expensive energy efficiency upgrades. If you put yourself in the shoes of a small landlord, the math has broken. Your mortgage costs have doubled, your tax benefits have been cut, and now the regulatory burden has increased. It simply isn't a profitable business for the little guy anymore. So they are selling. We are seeing a massive exit of private landlords from the market. About 18% of all homes for sale right now are former rentals. Now, you might ask, if all these landlords are selling, shouldn't prices drop? This brings us to a concept economists call the trilemma. It explains why we feel stuck. Imagine a triangle. The three corners are 1. Affordable home prices. 2. High household income. 3. Low mortgage rates. To get back to the affordability we saw in 2019, you need to drastically change one of those corners. You either need home prices to crash by nearly 40%, you need incomes to suddenly jump by 60%, or you need rates to drop back to near zero, specifically 2.35%. The problem is, the system is designed to prevent all three of those things. Governments won't let prices crash 40% because it would destroy the banking system. Central banks won't let incomes jump 60% because that causes hyperinflation. And they can't drop rates to zero unless the economy collapses completely. So, we are left with the least bad option: stagnation. High prices, moderately high rates, and low volume. The only inventory moving right now is driven by what realtors call the 5 Ds: death, divorce, debt, displacement, and degree. Basically, unless a major life event forces you to sell, you aren't selling. If the UK is dealing with a slow exodus, Canada is facing a much sharper cliff. The Canadian housing market has a unique structural risk that doesn't really exist in the US. In the US, you can get a 30-year fixed mortgage. You know exactly what you're paying for decades. In Canada, mortgages typically renew every 5 years. Back in 2021, rates were rock bottom, around 1.5%. People stretched themselves to buy expensive condos in Toronto and Vancouver because the monthly payment was cheap. Well, it's 2026. Those 5 years are up. Those mortgages are renewing now. But the rate isn't 1.5% anymore. It's more like 5.5%. For a lot of households, that means their monthly payment is jumping by 40% or 50% overnight. The banks saw this coming, and they were terrified of a wave of defaults. So they started using a mechanism called amortization extension. It sounds technical, but it's actually pretty scary. Basically, to keep the monthly payment from exploding, the bank extends the life of the loan. So instead of paying off your home in 25 years, the schedule shifts. You're now on a path to pay it off in 40, 50, sometimes even 60 years. In some cases, the monthly payment doesn't even cover the interest. The unpaid interest gets added to the principal. The debt grows every month, even while you pay. That's called negative amortization. It keeps people in their homes, which stops a crash, but it turns homeowners into permanent debtors. You aren't building equity anymore. You're just renting the apartment from the bank, and you paid the down payment as a security deposit.
So, we've looked at the traps in the West. But remember Alex, our institutional investor? He's actually putting capital to work. He's just not doing it in stagnant markets. He's looking at Poland. Poland is interesting because it's transitioning. It's a growth story. But there is a specific technical change happening there called the protocol switch. Without getting too bogged down in jargon, the Polish banking system is moving from an old interest rate benchmark called WIBOR to a new one called Polster. This transition has created a lot of uncertainty for regular Polish families. Mortgage rates there are high, around 7% or 8%. Here is the math Alex is looking at. It costs 8% to borrow money to buy a flat, but if you rent that flat out, the yield is only about 6%. For a regular person borrowing money, that is a bad deal. You lose money every month. But Alex represents institutional money. He isn't borrowing at 8%. He has cash. For a cash buyer, a 6% steady return in a growing economy is fantastic compared to the frozen markets in London or Toronto. So what we are seeing is the rise of the private rented sector, or PRS. Big funds are buying or building entire apartment blocks. They manage them professionally, like hotels. While the individual buyer is priced out by high rates, the institutional buyer steps in to fill the supply gap. It's efficient, sure, but it represents a shift in wealth ownership from individuals to large corporations. So, where does this all lead? If we look forward to, say, 2030, what does the housing market look like? For someone like Ben, the dream of buying low probably never materialized. The market didn't crash, it just recalibrated. We are moving toward what you might call the subscription economy for housing. Instead of owning a depreciating asset with an old roof, Ben might live in a modern corporate-managed tower. It's convenient. It's called living as a service. He pays a monthly fee. He gets an app. If the sink breaks, he clicks a button. He might have different tiers of service: silver for a basic unit, gold for gym access and better views. It's a comfortable life, but it lacks the one thing housing provided for previous generations: forced savings. He isn't building equity. He isn't locking in his housing costs for 30 years. He is subject to inflation every single year. Meanwhile, Alex, the asset owner, is doing fine.
He owns the boring stuff, the bricks, the land, the energy-efficient retrofits. This is the great divergence. We are seeing a split between those who own the infrastructure and those who pay to subscribe to it. So, what is the takeaway here? It can feel pretty bleak, but I think it's actually empowering to know the truth. The lesson of 2026 is that the old playbook doesn't work anymore. The advice given to our parents, stretch to buy the biggest house you can, it will always go up, was valid in a world of falling interest rates. We don't live in that world anymore. The squeeze isn't a temporary dip, it's a structural reset. If you are waiting for 2019 prices to return, you are fighting the Fed, the banks, and the insurance industry. The goal now isn't necessarily appreciation, getting rich from your house. The goal is stabilization. If you can buy, you buy to lock in your costs, to escape the subscription model, and to gain autonomy. You buy a home to live in, not as a lottery ticket. The market has changed. The easy money era is over. We have to accept the new reality. Date the rate, marry the price, but divorce the dream of effortless wealth. We are Dream Meta Visual Studio. Thanks for listening to this investigation into the housing market trap.